Good afternoon, good morning, and good evening to everyone dialing in. My name is Leo Marshall. I'm the CEO of Europe for Galaxy Digital, and I also run our global distribution efforts. It's a pleasure to be here in Dubai. We've got a great panel in front of us today. We're going to be talking about the evolution of crypto from speculation to sophistication now. So maybe taking a step back, what we'll do is we'll ask each of our guests to do a 1-minute intro real quick. But the real question I'm going to have for them is 2022, we saw the blow up, a big bust. We saw crypto adopt traditional finance risk measurements. And then emerging from that, we began to see the ETFs. We began to see options emerge and some consolidation amongst companies in 2025. Maybe starting with yourself, Shiliang, a brief intro, and then talk to me about where you see that sophistication of crypto going forward from here.
Yeah, of course. So thanks for having me. My name is Shiliang. I'm the founder and general partner of Eminency Group. We're a multi-strategy, liquid digital asset fund. And previously, I co-founded a firm called Arbalest Markets, which was recently acquired by FalconX. Yeah, there it is.
I'm Darius. I'm the founder of QCP Group. QCP is Asia's leading digital asset trading desk. I think we also have a fund management company called Primrose that does quant strategies on digital assets. And good to be here.
Thanks.
Hey everyone, thanks for having me. My name's Armani, founder CEO of Backpack. We're a wallet, a crypto exchange, a group of 10,000 mad lads all over the world. So happy to be here.
Great. So maybe starting with yourself, Shiliang, give us a Twitter-style, high-level overview of how you've seen the space evolve in the last couple of years.
Yeah, I don't tweet much, but yeah. So I think post 22, we saw a real shift in power dynamics, right? I think pre 22, exchanges in terms of holding assets. There was not a lot of buy-in and acceptance of off-exchange solutions, right? Kind of the disassociation of custody of customer assets with exchanges and clearing and everything, right? I think post 22, there's a real shift in power dynamics where it became imperative, essentially, for the exchanges to survive, to recognize that they needed to this disintermediation, right? And so a lot of exchanges started to accept clear loop and off-exchange solutions. We started to see a separation of custody and so I think that's one progress, right? That we've seen. And then separately, when I speak to LPs and other partners, OTC providers, et cetera, they're looking for more transparency, right? They're looking for tri-party repo. They're looking for more transparent margining and collateral, things that we kind of took for granted pre-22. And so those are some of the things that we've seen really rapidly progress post FTX.
Armani, tell us about what your firm is doing and how it's contributing towards that transparency.
Yeah, sure. So, I think this conversation around disintermediation is on the one hand correct. You do want to segregate execution and custody, and that's a concept taken from TradFi. But on the other hand, it ignores what makes crypto systems unique, which basically boils down to these computational integrity guarantees. You can get this in various different forms, whether it's zero-knowledge proofs or more kind of traditional kind of state machine replication approaches that blockchains like Solana or Ethereum would apply. But I think that is maybe the part of the conversation that the TradFi orientation misses, which is a long-winded way of saying, okay, I see a series of bits and bytes. How do I know they're correct? And everything from transaction ordering to liquidations to the concept of a fair or a mark price all kind of goes into this. And so you need to not only disintermediate parts of the stack, but you also need to be able to prove computational integrity, because that's just as important as custody, especially when thinking about margin systems, when risk, I would argue, is scarier than custody. And I would take it even a step further. When talking about custody, it's not enough to just segregate it, because you're just offloading the risk to another single party. You still have a single point of failure, even if they're a fully qualified custodian. And ultimately, what you want is to have a set of parties, ideally, that are able to custody the assets, prove the integrity of the state, and be able to actually facilitate deposits, withdrawals, transfers, and so on and so forth. The challenge is that traditional finance and the whole compliance regime that runs various parts of the world doesn't have any concept of multi-node operator networks. It's all built around single kind of centralized parties that you can basically point a finger to and blame if something happens, and they have all these internal processes and auditing and controls that can solve these problems kind of at the human level. And I think that is the evolution that we've yet to see, especially when thinking about regulation and compliance, which is this much more crypto-native approach to asserting the integrity of the state. And so I think that's kind of the lens through which we look at it, which is a combination of not only compliance problems, but solving this kind of at the kind of core engineering level as well, to be able to make these types of assertions that you can actually verify in a trust minimized way.
I love that answer. I'm going to go to you, Darius. Do you see traditional finance adopting execution on-chain protocols? And if you see that happening, who does traditional finance sue when it goes wrong?
It's a tricky question. I think traditional finance has dabbled in this, and they play in it in terms of testing and trying to get some alpha. But there are two reasons why they cannot go balls in on this. One reason is, of course, capacity, liquidity. The other reason is regulatory, right? And part of that regulatory reason is also your point that who do they go to if anything happens. So I think regulators will be more and more concerned about DeFi protocols and on-chain protocols. From a Singapore standpoint, the MES is very, very stringent on this topic. I think because it's a very AML KYC kind of concern. But at the same time, I think for large institutional trading firms, it's going to be a capacity problem, right? You can make good returns on $5-10 million deployed there, but can you make good returns on a couple $100 million? And I mean, if you have a sovereign guy that's looking to deploy a minimum $500 million, this is completely out of the question.
Right.
Yeah.
Maybe sticking with you, Darius, for a second. Talk to us a bit more about what you're seeing in Singapore. You mentioned sovereigns. We've spoken about spot execution. What else are you seeing emerging in Singapore that folks in this room may not be aware of?
Well, to answer your question, let me answer your first question together at the same time. I think what we see is, while there's been a development and evolution in the way, institutionalization of crypto, as I like to call it, I think one line in the sand that saw a real tectonic shift was the launch of the ETFs, right? The moment that launched, suddenly Bitcoin became a Wild Wild West asset to become a acceptable investment asset. And this other thing that we saw is also a shift of liquidity from other crypto assets into Bitcoin. So from a market maker's perspective, we saw liquidity drain, let's say options, for example. We saw liquidity drain out of Ethereum, Solana, and the rest into Bitcoin, and in a very big way. And I think we continue to see that as well.
What's the main driver behind that?
I personally think part of it is, I think ETFs, seeing the response to the ETFs in the US, that Bitcoin captures the American investor, American institutional investors' attention. Ethereum doesn't as much. Second thing I think actually is possibly staking has drawn spot liquidity out of Ethereum, whereas Bitcoin hasn't done it. That's probably a very debatable thing, but that's my own personal opinion. But Bitcoin has become the cornerstone for institutional attention in the space, and I think that's what we see. Specific to Singapore, we are seeing a lot of interest, right? SGX has just launched a perpetual swap contract on Bitcoin as well. But I would say by and large, the Singapore regulator sees crypto as payments. So it's stable coins, and they sort of has this very clear definition of what crypto is, and anything outside of that is not within their purview. So at least there's clarity. But in terms of it sort of doesn't encapsulate a lot of the other market as well.
Appreciate that. Shiliang, maybe go back to yourself. With the changes in the administration in the US and the rise of the perpetual stock market, how do you see the retail market and the institutional market expression of risk change over time? For example, do you see the perp market continue to grow? Like, why isn't the option retail market bigger than it is currently? Like, how do you see that space evolve?
Yeah, I think, one obviously good, the administration itself has been good for the space in some ways, right? I think it's, whether you call it deregulation, regulatory clarity, it's, lifted a lot of barriers. With that said, for us, more crypto-native firms, institutions, trading firms, it does open the floodgates a bit, right? I think it brings in a lot more competition extremely quickly, right? You've already seen headlines of Citadel getting back into the space. I think the prop trading firms, the traditional prop trading space prop trading firms are already ramping up their activities, right? And those are the real sophisticated players with massive balance sheets that can squeeze out a lot of the alpha that has been in the space for firms like ours, right? I think another piece is, as you said, we're starting to see U.S. exchanges, although via their offshore entities, start to, dabble in the perpetual markets, right? And I think at some point, there probably will be perpetuals, listed in some capacity in the U.S. The question, I think, is will retail continue to access crypto markets through crypto-native platforms like a Coinbase? Or will you start to see Robinhood and others start to list these products very aggressively, very quickly? And retail's already there. They're already trading equities, gold, FX, commodities, whatever, on a Robinhood platform. And so they already have most of their assets parked there. And now they can trade crypto directly within the rest of their assets, right? And so that feels like a better experience almost. And so I think that's a big question for a lot of the crypto-native platforms in the U.S. is, while there is regulatory clarity and deregulation, all of a sudden you're competing heads-on with all the traditional brokerages and platforms that, in some ways, have a head start in kind of retail distribution and adoption, right?
Armani, similar question to Shiliang. Do you see the existing TradFi retail firms eating crypto, or do you see the crypto-native firms eating TradFi?
Yeah, it's a great question. I think there's a couple different ways to look at this. So I think the first lens I would look at this question through is kind of maybe through the lens of like internet companies. And basically the exact same questions were asked with respect to native internet companies versus brick and mortar stores. Like, is Amazon going to compete with Barnes & Noble, or is Barnes & Noble going to rip a website and take over Amazon, right? And time and again, whenever there's these types of new kind of technology kind of leading kind of evolutions of traditional industries, it's always like the native platforms that do something a little new, a little different. They kind of intuitively understand what makes it special, and so I think that's like maybe the first lens I would look at it through. I think the second lens basically boils down to a combination of geography, regions, and opportunity cost of capital. So ultimately, like what crypto does really well relative to TradFi is it opens up capital markets, not just in the U.S., not just in developed countries, but everywhere around the world, right? Like I'm an American, I grew up in California. We have folks in Dubai, we have folks in Tokyo, we have folks in France and Germany, we have folks everywhere. And our user base is everywhere. And I think that's really the core difference, at least when thinking about this through the lens of traditional companies like in the US, that is pretty kind of special and unique, especially when thinking about the intersection of Western and Eastern markets. And I think that's kind of one of the big things that we think about a bunch, especially, I guess we self-identify as like a Western company or whatever, but I live in Tokyo, right? And we are really focused on Asia retail and bringing them into crypto. But I think what we're seeing right now is the evolution of not only crypto companies, but as you said, TradFi companies to answer this like opportunity cost of capital question, which basically boils down to if you're going to pitch somebody that you're a primary financial services provider, whether it's a traditional brokerage, whether it's a bank, whatever, you basically need to look at somebody straight in the face and be able to say, well, you can do more with your money here than you can anywhere else, right? And so, whether it's Coinbase or us or Robinhood, right? We can't just like rest on our laurels and say, well, you have Bitcoin here, and you see, Kraken just opened up equities, right? And it's because of this question, right? And so they need to be able to offer all of these products for attention. Otherwise, you're just going to go elsewhere, whether it's Charles Schwab or whatever. And I think the big step that I think we're really passionate about and that I wholeheartedly believe is like the on-chain economy, right? Things like self-custodial wallets and how that's going to evolve, and really kind of this long tail of whether it's user-generated assets or financial protocols or primitives that are being developed on chain, not just from one kind of traditional financial firm, but from thousands or of developers all around the world. And getting access to that, I think, is really the thing that is not on TradFi's roadmap whatsoever. And so I think there's a bunch of ways to tackle this problem, but I am generally I guess it's my job to be bullish crypto native companies, but I think that's kind of the way I would frame the conversation.
And you think retail would prefer accessing that via their wallet versus a Web 2 UI?
I think there's a question of user experience. You can talk about things like the DeFi mullet or whatever, where it looks and feels like, Robinhood or E-Trade or whatever, but you're actually hitting DeFi in the back end. I think, there's nothing from first principles that says you can't have an amazing user experience on DeFi. But I think it's going to be all about executing on that at a very high level, which basically boils down to, product people working really hard that actually care about this stuff. And so I think that's kind of the end state that I see.
Can I answer this as well?
Yeah, go for it.
So two things, from a prop trader's perspective on TradFi or native, Shileng and I were talking to one of the old school option market makers yesterday, and he said that with all the TradFi guys coming in, the candy store has turned into a dog meat store. It's a lot less attractive and a lot less easy, no longer candy to pick. But to answer the second question is, I think in 5 or maybe 10 years' time, 5-10 years' time, we won't be able to tell the difference. Because I think the very subtle disruption that crypto trading brings might not even be a technological disruption, right? It's very simply being able to trade 24/7, live margining, auto liquidation, collateral in kind, which lowers the cost. So I think the two worlds will start to merge, because it's not really a technological thing, right? It's Nasdaq or CME is going to trade a bit like Deribit or Binance,
right? And
then and then they are going to have clearing a bit like Nasdaq. So I mean, you're not going to be able to tell the difference, and then the products will start to merge as well. So I guess the answer is that the divide will break.
And I would just quickly add that don't underestimate kind of like generational shifts. Right? I think there is a whole generation of young individuals that perhaps their first experience or foray is crypto first or DeFi first or on-chain, right? And so they've grown up with the user experience of actually, not necessarily like a Charles Schwab account, but actually, spinning up a MetaMask wallet and engaging like Curve or Uniswap or whatever, right? And so that in itself could be a generational behavior shift that does favor crypto native platforms over time.
Super interesting answer. Let's take a step back from retail to sovereigns. Maybe with yourself, Darius. In your conversations in Asia, how are sovereigns thinking about the space? How has it differed in the past?
I think the use case of crypto in Asia, and particularly some of the frontier markets in Asia, is extremely important. Guys in US, Europe, where they have open economies or open currencies, won't really feel this. But if you have frontier Asian markets that don't have proper access to global capital markets, crypto becomes a very, very existential thing for them. A lot of them have closed economies and dependent on their neighbors, and they end up with revenues in one currency, liabilities in another. Bitcoin or even stable coins become a solution to this problem for them on a national level, right? Not only does it give them more revenue, it's a fungible cross-border fungible asset. And thirdly, it gives them access to global markets or global capital markets where they previously had not. So Central Asia, Southeast Asia, some of these economies, I think a lot of them are buying Bitcoin, mining Bitcoin, and then looking at how Bitcoin impacts their countries. So I think something to look out for in the next couple of years. You will see a lot of these guys emerge and become Bitcoin powerhouses, especially with the geopolitical situation, the big powers fighting with each other. I think having an asset that is finite, having an asset that's globally acceptable is something really quite powerful.
Do you see, I mean, it's fine buying Bitcoin, but talk to me a bit about, maybe yourself, Shiliang here, talk to me a bit about the opportunities in yield and lending, because it's great having bought Bitcoin, but then how do you avoid it simply being a dead asset on the balance sheet?
Yeah. Well, there are a couple of ways to get Bitcoin yield, right? I mean, I think one of the ways is collateral for financing. That's a very important one because that solves some of their problems. I mean, you've seen El Salvador try this, Bitcoin-backed bonds, and I think you see more sovereigns try this where, their country's credit rating might be low and their borrowing cost might be 8-9%. But you put Bitcoin as collateral, and that drops the rating. So financing is one use case. I mean, Shiliang, myself, we both run strategies that active management of Bitcoin allows you to monetize either volatility or forwards in order to get return on your Bitcoin. That's another way. And structured strategies that we provide as well, allows you to monetize the same thing in a more set way and allows you to you take some risk. There's always some risk when it comes to Bitcoin, but allows you to structure the risk reward such that you can earn a yield in Bitcoin without much downside.
I think as crypto Bitcoin gets more institutional, we don't have to reinvent the wheel, right? I think products like accumulators, yield-based products, they've existed in traditional markets, especially in Asia, right? For a long time in other assets, and Bitcoin, I think, will be no different, right? It's already come out and existed in 21, 22, with Babel and all these products back in the day. And so as it becomes more institutional, I think, and regulatory clarity, then these products will also emerge front and center in the US as well. And yeah, I think the digital nature of it, the kind of fungibility, transportability of it, makes it a lot easier to engage as a form of collateral than, let's say, potentially gold bars or anything. So that has an advantage as well versus some other assets.
Do you see your peers and competitors operating more in the ETF space versus the underlying Bitcoin asset, and if so, why?
Yeah, I think crypto native firms are still obviously touching more of the physical, Bitcoin, right? Whereas I think traditional firms are accessing more from the ETF perspective. I think one is they already have the traditional rails and access to traditional prime brokers that have kind of set up already, IBIT and ETFs and whatnot, and not necessarily support, physical Bitcoin. And so what you see, when you look at a 13F and you see Millennium, owns $1 billion of Bitcoin, they're not necessarily just buying and holding it, right? I think they're using it for a cash carry trade, a funding trade, and they can basically, subscribe to IBIT, bring that to their traditional PB, get access to 5, 6, 7x leverage, and basically loop it. And in some ways, it's kind of like leverage looping, like a Morpho strategy, except you're doing it through a traditional prime broker, right?
And do you think that's a source of additional liquidity in the space that we didn't have previously?
Yeah, absolutely, right? I think eventually, for options, for example, right? It was always Deribit that dominated the options market. I think now, the question is at some point IBIT options going to flip Deribit options for Bitcoin options, right? Maybe not. But I do think that's a valid question because there is so much more capital and balance sheet and money on the other side of the fence than within crypto.
Amani, what is the one belief you have about where the space goes that you think is underappreciated? And by the way, the two of you are going to have the same question, so you get to think about it a second.
I think it depends on who you ask this question to. I think fundamentally, I mean, so like let's think about like maybe what's happening right now. So there's the traditional finance folks that view the world one way, and there's the crypto native folks that view the world another way. And there's a bunch of people experimenting with many different crypto products with many different properties, whether it's different financial primitives, different L1 or L2 networks, or building kind of integrations into their existing consumer base. I think it's fair to say right now crypto is very small relative to TradFi. It's kind of a drop in the bucket. It's irrelevant. And I think most of us are here because we think it's going to eat finance in the same way that software ate everything. It's going to be ubiquitous. It'll become invisible. It won't be DeFi or CeFi. It'll just be finance. And if you go into that version of the future where the entire world is using crypto, it's not just billions of dollars, it's trillions of dollars, and everybody's using it. And you ask yourself the question, well, what are the companies and protocols that are going to be built in that future? I think there's two properties that I think you need to have. And if you don't have either of these properties, you're kind of on a road to nowhere. I think first thing is, at the protocol level, is censorship resistance. So if you're building an L1, if you're building a DeFi protocol, if you're building like a Uniswap, an Aave, a Jupiter, a Solana, an Ethereum, whatever, you need to be censorship resistant. And anything that is not censorship resistant will eventually be censored. It'll want to be controlled in whatever country or region that it's being operated in. This is super obvious to TradFi folks. It's super obvious to anybody that's run a centralized exchange. It's not so obvious to, I think, maybe some crypto native folks on how important the censorship-resistant property is. And so a lot of people like to frame the conversation in the concept of like decentralization, which is a spectrum, but really the conversation needs to be framed in the context of censorship resistance, which is binary. You're either censorship resistant or you're not. And if you're not, then you have another option, which is you can be compliant. Also a very obvious thing to folks in TradFi, not a very obvious thing to crypto native folks. And I think you're seeing this with all the large centralized exchanges. Eventually, you get so large to where the governments around the world start paying attention to you, and compliance actually matters. And if you want to become part of the fabric of society, you don't want to be just some type of offshore, unregulated thing that's maybe is some gambling casino or whatever. But if you actually want to underpin the world's economy, then these two things really matter. And I think that's kind of one of the things that I think a lot about.
Darius.
Yeah, this might be a bit controversial, but I think that one of the things that underappreciated, especially by crypto natives, is what the Bitcoin Treasury list codes are doing. The MicroStrategies, the MetaPlanets, to some extent you guys as well. Because, and I say this why, Sam Bankman-Fried, am I allowed to say his name?
You can
Sam
say his name.
His vision was to bring the entire world and tokenize it in FTX. Tokenize equities, tokenize everything, tokenize. So you bring the world and tokenize it into crypto. I think the value for us as digital asset guys is actually the other way around, right? Taking our product and bringing it to the world and through their distribution channels, giving them access. So you go from a $3 trillion market to a $1,000 trillion market. That's the value for us. So, a lot of native guys think that, this is so TradFi, but we are delivering our product to them in their worlds, right? So I think that's a bit underappreciated.
Super interesting. Shiliang.
Yeah, I guess I would just add, completely agree with Darius and Armani, but I think the past few years historically, there's been a lot of from the crypto native, I would say, crowd pushback against regulators for some for right reasons, but I do think it's not actually so bad if major parts of the crypto industry actually, are actually deemed securities, for example, right? I mean, maybe that's controversial, but I think if it was securities and deemed securities, that actually creates a lot of regulatory clarity. It's a path to actually bring a lot of the sideline capital that historically has not been able to engage with these securities. It's capital that can actually pump our bags and actually support the market because there's just an endless supply of token supply, right? Where is that additional supply going to come from? Where is that capital going to come from? it's you need the actual like real capital behind it, right? And so I think regulatory clarity via actually securities and securities laws could actually be a boon that brings additional capital to crypto markets.
And what looks differently, because you could argue in the past they said there was regulatory clarity. So what specifically would you be looking for now that we didn't have in the past?
I mean, I think everything around like, and I don't know, we're out of time, but like everything around like crypto listing and like it seems like we're kind of reinventing the wheel in terms of like crypto listing on exchanges, and like it's basically converging to like the IPO markets in some ways, right? And so if there was more like clarity about like how a crypto token TGEs and gets listed on exchanges, and how investors and team members and venture funds, et cetera, like behave around it, I think that also can be very supportive of the markets.
Appreciate it. Well, look, thank you very much, everyone, and yeah, thank you all.
Thank you, Leon.